We'll now start the tutorial section. Our speaker today is Professor Andrew Low from MIT Sloan School of Management. You may use the Q&A function to leave your question if you are participating online, or wait till the Q&A at the end. Let's welcome the program chair, Professor Tai Ma, to introduce the keynote speaker.
Good evening and good morning for everyone online and on site. This is a very special year for all of us facing the pandemic. And the conference, this is the first time the conference over 28 years, the first time is organized, partly virtual. Can you hear me? Can you hear me? Yes, okay. So it's probably because of this, we have this opportunity to have invited Professor Low to give a tutorial on a most timely issue, making sense of financial market dynamics in a post-COVID world. And his lecture obviously will be delivered online. And since I'm going to give a more formal introduction to Professor Low at his tomorrow's keynote speech, I'll just make a brief introduction here. Professor Low is a chair professor at the MIT Sloan School, and he's highly regarded for both academic achievement and professional performance. He is the winner of numerous prestigious awards. I'll explain them in detail tomorrow. His current research spans several areas. For example, healthcare, finance, and evolutionary models of investor behavior, and econometrics of financial markets. Many of us may have heard of or read his influential works and his recent award-winning book, Adaptive Markets. In fact, I have a Chinese version of your book. Very enjoy reading it. Ladies and gentlemen, would you please welcome Professor Low.
Well, thank you very much. I want to begin, first of all, by wishing all of you well and hoping that you're all staying safe and healthy amidst this pandemic. I also want to thank Professor Ma for inviting me to give this tutorial and tomorrow's keynote lecture. It's a pleasure and a privilege. And my only regret that I can't be with you in person at the beautiful city of Kaohsiung. And I also want to thank Gaoli Zhongxue Daxue for hosting this wonderful event. What I'm going to talk about today is my perspective on financial market dynamics in the midst of the post-COVID world. And let me begin by just sharing with you the starting point of my journey, which very much is related to the book that I published, which Professor Ma kindly noted. I want to begin with something that I think all of us have seen in our field, which is the main focus of the typical graduate, undergraduate education in finance, that is the efficient markets hypothesis. We all believe that markets are efficient in the sense of prices fully reflecting all available value, except for the fact that every once in a while we realize that there are counter arguments and that markets actually behave sometimes irrationally. And so the question is, how do we bridge this gap between efficient markets and behavioral finance? It's a little reminiscent of when you were a child and you occasionally would listen to your parents arguing. And remember how distressful that was? You loved them both and you just wish they would stop fighting and get along. And that's very much how I found myself after having gone through graduate school and learning the efficient markets hypothesis and believing it, and then encountering some really persuasive critiques of that idea. So I want to start this tutorial with a little bit of background on how I resolved this controversy, and then I'd like to apply it to the COVID pandemic that we're dealing with right now. So let me just give you a quick summary of how I think about markets. The traditional finance framework that I'm going to describe in a few minutes is not wrong, but it's incomplete. It's limited in the sense that it is really based on an idea of physics. And as an economist, I can admit I have physics envy like all of my colleagues. We wish that we had 3 laws that explain 99% of all behavior the way the physicists do. But instead, we have 99 laws that explain maybe 3% of all behavior, and it's very, very frustrating. So I ended up writing this book that Professor Ma mentioned, Adaptive Markets, and it is actually now translated in Chinese. I'm very proud of that fact. So you can take a look at it in whichever language you find most comfortable. The basic message is actually pretty simple. The message is that in a stable environment, stable financial policies make sense. But in a dynamic environment, you need to be able to engage in dynamic financial policies. And that's what the adaptive markets hypothesis is all about. And the fact is that the current environment is highly, highly dynamic. So we really need to think much more about how to adapt to changing market conditions. You know, the economists have a phrase that they tell politicians, it's the economy, stupid. And I think that biologists should be telling economists it's the environment, really, that drives behavior. So the adaptive markets hypothesis, which I'm going to describe on the next slide, is the framework that I look at for understanding financial market dynamics, and one that I think is actually going to be very useful for thinking about what's been going on with respect to COVID. So to summarize, the adaptive markets hypothesis has just 5 basic ideas. Individuals, they act in their own self-interest, and I think all economists, we would agree with that. But starting with points 2 through 5, we depart from traditional neoclassical economics. Individuals, we make mistakes. We engage in what Herbert Simon calls satisficing behavior. We don't optimize. We come up with heuristics that are good enough. And we learn and adapt in order to generate those heuristics. Competition that drives the adaptation and innovation. And ultimately, it's really the complexity of that type of evolutionary process that gives us what we look at as market dynamics. The evolutionary biologist Theodosius Dobzhansky famously said, "Nothing makes sense in biology except in the light of evolution." And I'd like to borrow his phrase and change it to say that nothing makes sense in finance except in the light of adaptive markets. And I'll try to back that up over the course of the next few slides with a few examples. So I want to start with the traditional investment paradigm. This is something that I begin with when I teach my Finance 101 students or my investment class. And I suspect that those of you who have gone through introductory finance for investments, you've come across the same thing. I'm going to start with the creation myth of the beginning of modern finance. And the creation myth goes something like this. In the beginning, and by the beginning, I mean 1964, in the beginning, Bill Sharp said, "Let there be beta," and there was beta, and it was good. With this single factor model, we had all sorts of implications. Correlation matters. Diversification is what ultimately drives investor decisions. Benchmarks, performance attribution, passive investing, indexation, hedging, portable alpha, risk budgeting, all of these things came out of this amazing framework that Sharp, Lintner, and others pioneered decades ago. But most importantly, this framework gave us a framework for discharging our fiduciary duties. In other words, it gave us a very clear set of rules for helping other people invest their money. The problem is that this framework requires a number of assumptions, as those of you who are theorists in the audience, you know. And these are the assumptions. The relationship is linear. It is static across time and circumstances. You can estimate the parameters accurately. The behaviors of investors are rational. Markets are stationary. And most importantly, they are efficient. And the question that I would ask you is, what if some of these assumptions do not hold? Now I have to be very clear. As an economist, we know that all assumptions are false. In other words, there doesn't exist a single true correct model. Models are meant to be approximations to a much more complex reality. And so the question is not whether assumptions are true or false, but rather how good an approximation are they to reality? And this is the point that I'm getting to. It turns out that these assumptions were, for decades, excellent approximations to reality. And let me give you an example. This is a graph of the S&P 500 cumulative return. What happens if you invest $1 in January of 1926 and you left it there all the way to July of this year? This is what it looks like. Now, I suspect that most of you don't recognize this curve. It looks weird to you, right? And the reason it looks weird is because I've graphed it on a semi-logarithmic scale. If you look at the y-axis is in a log scale. And the reason I did that is because on a log scale, identical vertical distances correspond to identical rates of return. And so what we see by plotting this graph is after the Great Depression, post-1930s, there was a period of approximately 6 decades where the assumptions of the CAPM were actually excellent approximations. In other words, by looking at the straight line during those 60 years, you could tell that, if you wanted to benefit from the equity risk premium, you didn't need to be a stock picker. You didn't need to be Warren Buffett. All you needed to do was to put your money in the S&P 500, and you would have earned your 6 to 8% risk premium pretty reliably over any 5 or 10-year period. The question that we have to ask ourselves is, over the course of the last 2 decades, do we believe that the time series properties are identical? Do we believe that we're living in a stationary world where the probability laws are the same, or do we think that maybe, just maybe, something has changed? And of course, I'm going to argue that actually the world is changing. It's changing at a much more rapid pace versus the previous 60 years. And this is true for many different countries, not just the United States, and for many different markets. For example, if we take a look at Japan, this is the Nikkei 225 from May 1945 to the present. And you can see that they had their period where it looks like the assumptions of the CAPM were approximately true. The question is, do you believe that the last close to 40 years, do you believe that that's a reasonable approximation? And I would argue that no, something changed in Japan. So this is the idea behind the adaptive markets hypothesis. It's that things change, and we shouldn't expect there to be a single law of motion that fits all the data, but that it's a complex ecosystem where various different parties are interacting all the time. Let me give you another example of where that non-stationarity plays a role. So one of the key tenets of modern finance is that there is a trade-off between risk and reward. And you can see it right here, looking at the various collection of assets from the Ibbotson data, now Morningstar. If you look from 1926 to July 2020, and you take a look at the first 2 rows, it's basically the mean and the standard deviation of various different asset classes. Large stocks, small stocks, corporate bonds, government bonds, and so on. What you see from the first 2 rows is exactly that risk-reward trade-off. Very high risk on the very left, small stocks, 11.7% expected return, standard deviation 28.2%. Large stocks, lower return, lower risk. Long-term corporate bonds, lower return, lower risk, and so on. There is almost a perfect monotonic relationship between risk and reward over the course of this 100-year period. That's what we have in mind when we think about the risk-reward trade-off, okay? But now, let me show you what the risk-reward trade-off looks like over rolling 5-year intervals, not over 100 years, but over 5-year windows. So this is a graph of 60-month, 5 years, monthly data, 60-month rolling window estimates of mean and standard deviation for the S&P 500. In blue is the geometrically compounded 5-year return that's annualized. And in red is the standard deviation of the returns during the identical period. And what we see from this graph is something really weird. In the 1930s, in the aftermath of the Great Depression, low returns, right? The blue line is below zero. Red line goes high up, high volatility. High volatility, low returns. In the 1940s, higher returns, lower volatility. In the 1970s, lower returns, higher volatility. In the 1990s, you've got lower volatility, higher returns. It actually doesn't seem like there's a risk-reward trade-off the way we've seen it in that 100-year sample from the previous slide. In fact, I'm going to argue that the risk-reward relationship that we know and love in finance, it doesn't necessarily apply across every possible time period. There are exceptions. Now, you might say, well, anything can happen over a short enough period of time. But for most investors, 5 years is a very long time. That's not a short period of time. And if you want to use the risk-reward trade-off and you want to make the argument that that has to hold over a 5-year period, well, this would argue that's not the case. In fact, can anybody tell me what the correlation is between the blue line and the red line here? Anybody want to take a guess? I realize that you can't really shout this out if you're actually in the conference live, but for those of you who are online, feel free to put it in the Q&A. Just put your answer. Just tell me what you think the correlation estimate is, or put it in the chat, because I think it's going to be a very interesting experiment. I don't know if you can visually see what it is, but I think you'll be surprised at the number. So let me tell you what the number is. It turns out that that correlation is minus 51%. Minus 51%. That's an extraordinary negative correlation. So the risk-reward trade-off definitely does not hold over shorter periods of time. So it turns out that when you take all of these things into consideration, there's actually a new investment paradigm that comes out of it. For every single implication of efficient markets, and believe me, there are many, every single one of these efficient markets implications has a counterpart in adaptive markets. And I don't have time to talk about it in detail today, but if you take a look at the book or any one of my lectures online, I describe a number of these implications. It's pretty significant. And once again, I want to emphasize the efficient markets is not wrong. In fact, it actually works remarkably well most of the time. The problem is it doesn't work all of the time, and we need to understand the periods where markets become much less efficient and that individuals start adapting. So the idea behind the efficient markets hypothesis and the adaptive markets hypothesis is that it allows us to bring together the rational and the behavioral in a mutually consistent, intellectually satisfying way. That's the framework that I'm going to use to try to understand this pandemic. Okay, so that's the background. I want to now turn specifically to COVID-19. And I guess I'm going to begin by making a comparison. I think it was Mark Twain who pointed out that history may not repeat itself, but it often rhymes. And so I want to go back in history to take a look at periods where we've experienced similar kinds of dislocation to what has happened over the course of the last 9 months to a year. And we've got to go back to 1918 to discuss the influenza pandemic. It is often called the Spanish flu, but it turns out that that's incorrect for reasons that I'll get to shortly. And the second example from history that I'm going to draw on, of course, is the 2008 financial crisis. Those are the two periods of history that I'm going to turn to for guidance in understanding what's been going on over the last few months. Okay, so let's start with the 1918 influenza pandemic. So first of all, the name. The reason that it was called the Spanish flu was because the pandemic was first reported in newspapers in Spain. But the reason that that is not at all indicative of where the pandemic began has to do with the fact that in 1918, the world was at war. And in particular, on the Allies side, all of the Allies had an agreement not to publicize the pandemic because they did not want to alarm either the populations of their various countries or the soldiers that were supposed to be fighting. And many of the soldiers were the ones that first got their influenza and brought it back home and really ignited the pandemic. And so Spain was not part of the war at the time. They were not part of the Allies in 1918. And so they had no news blackout and they were able to write about the war. And so that's why people think it's the Spanish flu. Now, in 2007, an economist by the name of Thomas Garrett at the St. Louis Fed wrote a study comparing the economic effects of the 1918 influenza pandemic to try to understand how it would compare with what was going on in 2007 at the time, the financial crisis. And so he wrote a rather interesting summary. There wasn't a lot of data, so he tried to pull together whatever data he could, and his conclusions were rather surprising. He concluded that actually there were very, very few long-term effects of the 1918 pandemic. The only short-term effect was that because the pandemic seemed to affect young, healthy men more than older individuals, partly because the influenza actually recruited the immune system to actually cause so much damage through this so-called cytokine storm. And so the younger men who had healthier immune systems actually got sicker. And so there was a big drop in labor force. And as a result, there was an increase in wages short term. There was an impact on GDP. But overall, there was very few long-term economic consequences of the pandemic. Now, I want to turn specifically to finance, since that's the topic of this SFM conference, and I'm a financial economist. If you take a look at what happened to the stock market, it's actually pretty surprising. Now, I'm going to use an index that we don't have a lot of data going back to 1918, but I'm going to use an index put together by the financial economist Bill Schwert at the University of Rochester. And it's a data set that is the Dow Jones Composite. It's a rather small sample of stocks, but it's the largest stocks. And so we can get a sense of how the aggregate stock market was doing back then. So I'm going to show you the returns from January the 3rd, 1916, all the way through December 30th, 1922. And notice that I have two specific dates highlighted, April 6, 1917, and April the 5th, 1918. Let me tell you what those two dates are. April the 6th, 1917 was when the United States declared war on Germany. That's when we entered World War I. On April the 5th, 1918, a year later, that was the first time that any news article came out about the 1918 influenza. It was an article that came out about an outbreak in a military camp based in Kansas of about 100 soldiers that got the flu. And that had happened a month prior, March of 1918. It turns out that literally 5 weeks after that, the number of influenza cases grew by a factor of 5. And so clearly that was an instance where the pandemic came from abroad into the United States. Newspapers were not allowed to write about any kind of a broad-based pandemic, so that was a very small article in a local newspaper, but that was the one case where we can identify there was some information about it. Now let me show you the stock market throughout this period of time. And remember, there was a news blackout, so we were not allowed to talk about any kind of pandemic. So the stock market went up and down and up. Basically, there was no obvious impact of the pandemic itself, and certainly during the worst part of the pandemic, which is the spring and the winter, the summer and the winter of 1918 and the beginning of the spring of 1919, the stock market was actually going up. So this is what we call phase one. That was from a period of around May or June, all the way through September of 1918. That was the first phase. The second phase, which was far worse, the second phase from September to January, September 1918 to January of 1919, that was the absolute high point of the number of deaths. Just to give you some scale, October of 1918, 195,000 Americans died in that 1 month. Over a 30-day period, 195,000. Now it's true that at this point in the United States, we have had about 270,000 deaths. But you have to keep in mind that in 1918, the population of the United States was about 100 million people. Today, we've got 330 million people in the US. So clearly the number of deaths per capita was way, way higher back then. And it was because there was no discussion of the pandemic, no social distancing, no masks, no nothing. In fact, you notice that there's a little red dot in the graph during that second wave. That red dot is November the 11th. It turns out that in 1918, in the 11th month, on the 11th day at 11 a.m., the United States signed the armistice where we ended the war and declared victory. On that day, which has now become a holiday in the United States, that's Veterans Day, on that day, let me show you a picture of New York City. These are crowds that was celebrating in the midst of a pandemic. The month before, 200,000 people died in this country. And people were celebrating in the streets. No masks, no social distancing, no sheltering at home. And despite all of this, and despite the third wave that killed more people, despite all of that, the stock market went up. Now, it did go down for a little bit a year or so after. The war ended and the war machinery slowed down, so GDP declined. But eventually, stock market not only recovered, but over the period from 1921 to 1929, we had one of the biggest bull markets in the history of the stock market at the time. In fact, those of you who are familiar with US history, you know that that period was known as the Roaring 20s. It was because the stock market just took off like a rocket ship. And ultimately, the tremendous growth that existed during that decade gave rise to the stock market crash of 1929 and the Great Depression. But the bottom line is that when we ignored the crisis, when all of these people died, the fact is that financial markets hardly noticed. I'm going to come back to that in just a few slides, but keep that in mind, okay? Now let's turn to 2008, the financial crisis. Clearly, what we observed during the fall of 2008 and the ensuing months thereafter seems very similar to what we've been experiencing over the course of the last few months. And clearly, the recession that hit the markets back then was very deep, and it took a long time for us to dig ourselves out. Tremendous amounts of policy intervention, unprecedented policy interventions by the Fed, by the Treasury, by the Congress, the SEC, all of the agencies, they all got together. $700 billion bailout package authorized by Congress called TARP. And of that 700 billion, 550 were actually issued and spent. And many, many programs were created to deal with the crisis listed here. If you take a look at the impact on employment, you can see that we were in a very deep recession. And if you look at the jobs that were lost during that period of time, it took us about 7 years before we were able to get things back to where they were before the crisis hit. That's an extraordinarily long period of time. What about the current crisis? Well, let's fast forward to today, and you can see that, in fact, the drop in employment was way, way steeper over the course of the last year, but we're already halfway back. And it's because there's a very important difference between 2008 and what we're going through right now. Yes, there are some real effects to the economy. If you look at the New York Fed's estimate of GDP growth, you can see that quarter by quarter, the United States GDP growth was very healthy at 2%, 2.5%, almost at some point near 3%. For a large economy like the US, that's really huge. But in the second quarter of 2020, we have a GDP growth of minus 35%. Now, that's come back, thankfully, but you can see that there's a very, very different dynamic. The recovery is well on its way here in the US, and over there in Taiwan, congratulations. You've been doing that recovery for quite a bit longer, and you are now at the point where you have even surpassed where we were pre-COVID. So now let me talk about the financial implications of COVID-19, now that we have that historical background. And I want to start with a few observations about the market, after all. The first observation I want to point out is that prior to COVID, nobody was talking about a financial crisis. Recall that 2019 was an amazing year for global stock markets. This is the MSCI World Index. And between January of 1929 and the middle of February, before COVID hit US markets, 29.1% rise. That's an incredible increase in market value. Something like $17 trillion of market capitalization was created in 2019. So nobody was worried about any kind of financial crisis. If anything, people were worried about maybe the markets are getting overheated. Maybe there's too much growth going on. And then, of course, if you take a look at markets today, you would hardly realize that there is a pandemic. This is a graph of the S&P 500 in blue and the NASDAQ in red from the beginning of this year to a few days ago. And clearly, there was a period where we got hit, and about the middle of February, and we went down, 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 down to around the middle of March, and then we started to recover. If you simply took that period of that down and up, and you simply deleted it, and you just put the two pieces together, what you find is that actually the pandemic doesn't look like it's had any impact at all. So I'm going to borrow a concept from the psychiatrist Elizabeth Kubler-Ross, who studied grieving and how we humans deal with loss, with death. And she came up with this idea known as the 5 stages of grief. It's denial, anger, bargaining, depression, and ultimately acceptance. Well, I want to come up with my own version of that for financial loss. There are 5 stages of financial grief. And let me tell you what those 5 stages are. The first stage is you freak out. You get scared and you take your assets out of the stocks and put them into cash. The second stage is a rebound. You realize that things aren't as bad as you thought, and now it's time to get back in. The third stage is recalibration. You're trying to figure out exactly what happened, and you want to understand a little bit more about the up and the down. The fourth phase is the adaptation phase. You now start to change your business model in order to deal with these kinds of structural shifts. And finally, the fifth phase of financial grief is what I call a high growth period, where after you've adapted, after you've dealt with all of the challenges of the existing business model, given you've got a new environment and you are successfully adapted, then you have a period of tremendous economic growth. Right now, in my estimation, we are in phase 3 of this 5-phase process. Let me show you. So this is a very nice table that was put together by the NYU finance professor Aswath Damodaran. I love his website. I encourage all of you to check it out. He does regular updates on valuation analysis for various different companies. And so he's written about global stock markets during the pandemic. And what he highlights is 3 of the phases that I pointed out. The first stage is from February the 14th. That's when the pandemic really hit US shores and our stock market declined, but stock markets around the world did as well. So from February the 14th to March 20th, that's what I'm calling stage 1. And if you look worldwide, markets have gone down all across the board, around the world. But now take a look at stage 2. Stage 2 is from March the 20th through September of this year. Dramatic recovery across all markets. The only market that didn't recover as much was the Mexican market, but even there, their decline wasn't as great as some of the other markets. And then phase 3 is from September the 1st to a few days ago. And here you can tell that we still continue to recover, but the growth is somewhat more muted. And we're now beginning to try to figure out what's going on. We're starting that recalibration process, and eventually we will get to the point where we're going to start adapting. Now, in this process, of course, there are a number of different winners and losers. And so let me give you an example. One big winner in the pandemic, Zoom video. So we're using their product right now. Everybody that I know uses Zoom in the academic world and many people in industry as well. It's a great product. And so clearly the pandemic has been enormously valuable for them, taking their stock price from about $69 a share to $440 in the matter of just 11 months. That's just phenomenal growth, right? Okay, now what about losers? Well, here's Carnival Corporation, the parent company for Carnival Cruise Lines. Clearly, they had a really hard time. Remember that cruise ship that was stuck out in the ocean because they had a COVID pandemic on board. Now, before you dismiss Carnival Cruises, we have to recognize that all of these companies are trying to adapt to these settings, and some companies adapt more successfully than others. That adaptation process is something that investors can take advantage of. Active portfolio managers have probably been enjoying themselves over the last few months, trading actively in being able to take advantage of these opportunities. For the rest of us, this is why we have diversification. We need to make sure that we're not totally concentrated on any one sector. But as I was saying, even in as hard hit a sector as cruise lines, we adapt. So before you just totally dismiss cruises, at $17 a share, I would argue that Carnival Cruise Lines is actually a pretty good buy, because I have news for you. People still want to take their cruises. In fact, you may not have realized this. I was shocked to have learned this, but the number of cruise bookings in 2021 is actually higher than the number of cruise bookings in 2020 pre-COVID. And so people are definitely still interested in taking cruises. And so we just need to adapt to the new conditions we live in. So Aswath Damodaran has a more compelling analysis of this kind of adaptation on his website. He looks at the winners and losers between February and September of this year. And if you look at the industries that have done really poorly, we're talking about real estate, oil and gas, reinsurance, air transportation, and so on, banking. Those are the organizations that were not prepared and that are not easily adaptable to the current COVID crisis. What about the industries that have done well over that time period? Well, software, retail online, healthcare, family and home furnishings, and so on. these are exactly the businesses that we rely on, given that we happen to be sheltering in place right now. And even more interesting, if you rank companies by their chronological age, how old are they? In the left side panel of this table are deciles with the youngest companies at the top and the oldest, most well-established companies at the bottom. And in green and red are their returns from February to November. It turns out that the older companies are the ones that are getting hit the hardest, just like with COVID-19. COVID-19 is hitting the older generation across the board, both in human terms and in corporate terms. And if you look at the right-hand table, what that's showing is companies stratified by earnings growth. And clearly, the faster growing companies, the younger companies, the tech companies are the ones that are actually being favored in this current crisis. These are the kind of dynamics that I see going on right now. The last example before I start to wrap up and want to leave plenty of time for questions and answers. The last piece I want to tell you about on the research side is that I've been working on a paper with some of my co-authors to try to understand how this global alignment is actually occurring on a much higher frequency timescale. So this is a co-authored paper that's in process right now. We don't have it posted yet, but in another few weeks, we hope to. This is with Monica Bilio, Loriana Pelizan, Mila Getmansky, and Abi Zarai. What we do in this paper is to use high-frequency data on 12 country ETFs. These are ETFs that are the major stock market indexes for a specific country. And we use minute-to-minute returns, 1 minute returns from January 3rd, 2012, all the way to May 29th, 2020. And what we're trying to understand is what the relationship is between these 12 countries from the perspective of their stock price returns. We pick ETFs because they all trade on the United States exchange, and that means that we can get contemporaneous observations during the 9:30 to 4 p.m. Eastern Time trading hours. And what we're going to do is to estimate vector autoregressions. We're going to take US returns and regress them on lagged returns of the 12 countries. So US returns this minute regressed on US returns the previous minute, Chinese returns, German returns, UK returns, Spain's returns, all of these returns for the previous minute. And we're going to do this for all 12 countries. So it is a very simple first order vector autoregression. We're going to do this every single day, a separate regression each day. And then we're going to average the coefficients over the previous 15 days. These coefficients, what they measure is the linkages between these different markets. For the longest time, US markets have been really central in the sense that if the US market moves significantly this minute, that has significant predictive power for the returns of all the other markets the next minute. It is literally at that time scale that the US has dominated financial markets. And so once you estimate the coefficients, you can actually plot them in a network diagram and use network analysis to get a sense of how important each of the countries is. So I'm sure that all of you have seen networks like this, these social networks, where each node is a person, and the lines between the nodes are the relationships, who knows whom, or who is married to whom, or who reports to whom in a corporation, and so on. And highlighted in red in this diagram are the nodes that have the maximum number of connections, because those are known as the hubs. Those are the most important central figures in the network. It turns out that using certain mathematical measures, you can actually identify which of these nodes is the most important. And this mathematics is the basis of Google's search engine. The Google PageRank algorithm is basically using a technique known as CATS centrality. So what I'm about to show you is CATS centrality measures of these 12 country ETFs and which of the countries is most important in predicting the returns of future country returns. This is the graph from 2012 to 2020. Now, there are lots of different lines here. It's kind of hard to see. But I want to emphasize two lines, the one in red and the one in blue. In blue is the US ETF. And in red is the Chinese ETF. And what we see is that for the vast majority of the early data, the United States absolutely dominated. It was the most important node in this network of 12 countries using high-frequency data. But over the course of the last few years, that's changed. Now, the US and China are actually pretty close in terms of importance. And if you try to identify the two events that really had an impact on this process, there are the two lines that I've drawn on the graph. The first line is when the US launched its trade war against China, and the second is COVID-19. Now, you can take those estimates and look at the maximum value of connectedness day by day, and then look at the network on that day. And so I'm going to show you three snapshots using a variance decomposition where I take the vector autoregression, I know which coefficients are the most important, I know what the variance contribution is of that coefficient, so I can actually calculate how important that is relative to other countries. And in 2012, you get the diagram on the extreme left, and you can see that that large blue dot, that's the United States. All of the other dots are smaller. It means that the US exercises large influence in terms of variance contribution to overall markets. Now, let's move to 2017. 2017, we've got a very different looking snapshot. Now, the US in blue is actually not that much larger than a number of the other markets. And now take a look at what happened when COVID-19 broke out. With COVID-19, the most important market by far was the Chinese market. And so what we conclude from this, and if you look at the quantitative measures over time, you can see that in fact, the variance decomposition does illustrate a general trend towards the US and China becoming comparable. What we conclude from this is that the world is moving from a unipolar to a bipolar system, that a combination of political and epidemiological forces have contributed to this. And now the financial system is really dominated not just by the US, but by US and China, and with other countries that are catching up as they develop more and more sophisticated markets. Okay, so I'm almost out of time, so I want to wrap up now and then turn it over for a Q&A. How do we put this together? How do we craft a narrative around COVID-19? Well, we do so by first observing the facts, which is that COVID-19 has been characterized by much steeper declines in real economic activity, but much steeper recoveries. There's currently no inverted yield curve. Gold, while it's higher, gold has not spiked the way it did during 2008. And so how do you make sense of that? The answer to that question is going to be given by the answer to the following three questions. The first question is, what is the source of the current crisis? And the answer is very simple. We know what the source is. Unlike 2008, where actually we didn't know for a long time. We thought it was residential real estate, But what does that mean? Exactly what is the underlying causal factor that we need to deal with? That's why it took us 7 years to get back to the same employment level as 2008. In this case, we know exactly what the cause is. This is the cause. Second, how widespread is the impact of our current crisis? And the answer is, it is absolutely, totally universal. Now, you may have thought that the financial crisis was universal in 2008, but I can tell you by comparison, it was nothing. And here's a very simple personal example. In 2008, I certainly was very focused on the financial crisis, without a doubt. And it was a lot of what I studied and what I spent time talking to colleagues about during the day and in the evenings. My wife, on the other hand, she was aware that we were in the midst of a financial crisis. But, apart from watching the evening news and talking to me at dinner, she didn't really have much to do with it. She went about her day. She brought the kids to school. She went and made lunch and dinner for them. She went about her activities. She didn't worry about the financial crisis every single minute of the day. But I can guarantee you that today, she is absolutely affected by the financial crisis. She has become a supply chain expert in supermarket delivery. She knows exactly when our local supermarket is getting paper towels and toilet paper and chicken and fish, because she has to, because there are only certain times when she can get those products. And every minute of every day, she is reminded that we are in a crisis. So it has far-reaching impact. Third question, what's the solution? It turns out that in this case, the solution is pretty clear. We got to deal with this. Once we deal with COVID-19, we're done. What we are in is in a public health crisis. A public health crisis is not a financial crisis. Obviously, a public health crisis has financial implications, and so Fed policy and other kinds of interventions are certainly needed. But the fact is that the reason that we are suffering economically is totally voluntary. We have decided as a world to put ourselves in a medically induced coma. Taiwan is a great example. You lock down your country almost from the outset, and as a result, the economic consequences have been much less in your country than in many other countries. But it was at great cost, because from a social and personal perspective, it was very difficult to do what you all did. And you deserve tremendous congratulations from citizens in the country and from people around the world for the example that you illustrated. But that tells us that throwing money at this problem is not enough. Unlike the financial crisis of 2008, where it was largely about money, about liquidity, about the so-called toxic assets, in this case, the source of the crisis has nothing to do with finance. So what that means is that in order to deal with the financial implications of the public health crisis, we need to deal with the public health implications. And that means we need to deal with the fear. And the only way to deal with the fear is to deal rationally with the underlying causes of those crises. We need policies that will address the pandemic at the very root of its various different origins. Monetary policy is a short stopgap measure that will not necessarily work in the long run. So, when will the crisis be over? Again, the answer is pretty simple. It'll be over as soon as we have vaccines. We have now one and possibly more on the way. When we have large-scale vaccinations, which probably will take anywhere from 6 to 12 months if we're lucky. Third, effective treatments if you do get COVID-19. We have a couple right now. It's not clear that they're all that effective. One thing that you should all know, and I hope you will take seriously, is taking vitamin D. There is actually now clinical trials that have been conducted to show that having higher doses of vitamin D reduces your chances of getting severe COVID-19 disease. So you should always consult your doctor, but particularly during the winter months, I would recommend that you seriously think about taking vitamin D, 2,000 international units. For those of you that are vitamin D deficient, you may want to think about 4,000, but consult your doctor about that. And of course, comprehensive testing. You can't manage what you don't measure. That's something that you figured out as a country at the very outset. So you started testing everybody. And once you understood where the infections are, you get engaged in contact tracing, you can then manage that more properly. Policy responses can be very helpful during this period, but at the same time, we have to be very cautious that sometimes these policies are actually inappropriate and they can hurt more than they can help. The bottom line from the central banking perspective is that we have to be very cautious not to engage in economic stimulus for too long. Otherwise, we might ultimately generate inflation, and that's also a very difficult problem to resolve. Okay, so let me wrap up by giving you my perspective. I'm not a particular economic pundit. I don't have my own column in the New York Times. I don't do a lot of interviews, but my MBA students, they ask me, what's my opinion? And so I feel obligated to tell them, so I thought I might as well tell you since this is a tutorial, and I'm expecting that there are a number of students in the audience. My current perspective, I'm going to divide into short-term, medium-term, long-term. In the short run, which is 1 to 6 months, we're going to see higher volatility of volatility, meaning that volatility right now is relatively normal, but at a moment's notice, volatility can spike. For example, if it turns out that we end up having a bad reaction to the vaccine that Pfizer and BioNTech have distributed, that could actually cause a real financial crisis. There are going to be recurring periods of instability, and we have to be very careful about how we deal with it from a policy perspective. And the reopenings that we've seen may ultimately have to be reversed. We're seeing that right now in the United States. California is in lockdown, and other states are considering that as the numbers start to climb. Just like the 1918 pandemic, the second wave may actually be worse than the first. We need to be really careful about that. And I'm particularly nervous about the next few months because, of course, we have Thanksgiving, we've got the Christmas and Hanukkah and other end-of-year holidays, New Year's, and then, of course, there's Chinese New Year's. There's all sorts of holidays that are going on where people like to gather. And so it may be the case that the combination of winter, the lack of sun and vitamin D deficiency, and these various different gatherings will end up causing a much worse second wave. And the bottom line is that we're all tired. We've all been exposed to tremendous amounts of stress. Let me now turn to a more optimistic perspective, which is in the medium run. Over the next 6 to 18 months, I believe that vaccines, treatments, testing, herd immunity, and government policies, all of these things will kick in, and we're going to see tremendous reversals and growing economic recovery. Countries are going to reopen. We're going to see stock markets surging even beyond where they are today in anticipation of that. And we're going to start getting into phase 4 and phase 5 of my 5 stages of financial loss. Stakeholders are going to adapt to a new normal. We're going to have new winners and losers, and that's going to usher in a period of tremendous economic growth from my perspective. That brings me into the long run. In the long run, I think that we're going to see a period that we've not seen before of new species emerging from these challenges. And that's why I believe that over the next 5 to maybe 10 years, there's going to be a tremendous bull market, just like the roaring 20s. People are going to be talking about the roaring 20s of 2020 and beyond. And what my worry is that now we will be planting the seeds for the next financial crisis, which will be due sometime between 2027 and 2030. That's my concern. So what's the bottom line? Well, my MBA students, they're all very worried about where things are going. So I tell them this. First of all, be patient. Don't get discouraged. Do not freak out. Expect business to take longer. If you're looking for a job, it's going to take longer. If you're going to try to do a startup, it's going to take longer. If you're trying to close a business deal, it's going to take longer. Use this period to reflect on your goals. Maybe you want to set new goals in the aftermath of this pandemic and begin to put together the plans to achieve those goals. The fact is that sheltering in place right now is a bit of a luxury that we don't have when things are normal, when we're expected to get on a plane and go visit parents and children and get involved in conferences. Now we have time to be home and reflect. Use that period wisely. And most importantly, you need to take care of yourself and each other. Manage your stress. All of us have been through a lot of stress. And so we need to spend time every day to de-stress. And that's what will allow us to not get distracted by COVID, to focus, and ultimately to adapt. I'm going to close with a quote from Winston Churchill, who knew a thing or two about crisis. He said, if you're going through hell, well, then just keep on going. And that's my advice for my students. There will be an end to this. The end is not yet here. We need to stick together and focus on dealing with the pandemic for the next 6 to 9 months. But if we do, we're going to come out of this just fine. Thank you very much. 谢谢大家.
Andrew, we still have 40 minutes. It's a 100-minute session, so no hurry.
I have plenty of things to say.
Yeah. Okay. Excellent, excellent talk. I've learned a lot. Is there any questions from online and on-site participants? Yes, Dr. Chen.
First of all, it's a great presentation and I learned a lot, and also recognize that the theories that we learned long ago wasn't exactly right. But the question I have right now is actually that there is a factor of mismanagement by Donald Trump. How do you factor in this factor? Basically, different countries come up with different response, but we may not admire the way Chinese adapted to this. Taiwanese is certainly doing well, but in the UK, in the US, seemingly that the leadership there is not taking their responsibility seriously. And there might be some speculation that there were some ill intention actually. So how do you factor in? And recognizing this, that the Fed is saying that they're not going to hike the rate anytime soon. But Biden's proposal is actually adding more stimulus and a new Green Deal. That's a lot of money to put in the market. So how would you expect, let's say, supposedly we're seeing long-term yields coming to reflect that there is a indication of inflation coming. So how do we take this all into account?
So Professor Ma, I now believe that the 40 minutes will have no problem filling that up just with this question. But there are several questions in what you asked and excellent points. So let me try to deal with 2 or 3 of them. First of all, I have to acknowledge that I am not a political expert by any means. So my opinion is worth nothing more than anybody else in the audience, and probably a lot less than some of the people who are political experts here. But as a citizen of the United States, I have to say that I am absolutely heartbroken by what has happened. 270,000 people have died in this country. And I don't know how many people could have been saved with better policies like what was applied in China, in Taiwan, in other countries. So in that sense, it's a very difficult thing to have to live with. However, before we put the entire blame on Donald Trump, and I'm not a fan of his or a supporter by any means, but I want to describe a little bit about what I see from a broader perspective. Donald Trump became president of the United States because US citizens voted for him. Russia may have interfered with the election to some degree. We don't know exactly what degree, but it seems pretty clear that they did do something. But I'm pretty sure that Russia did not manufacture 70 million votes out of thin air. And so you have to first start with the acknowledgement that this politician, as much as you and I may disagree with his policies, he was elected by US citizens. And one of the principles on which he was elected, irrespective of whether or not he really believes in it or not, was the idea that American citizens should be free to decide their own destinies. And one of the things that he has pushed to the great detriment of people around the United States is that you don't have to wear masks if you don't want to. And that's right, that's a policy that has caused a number of deaths. I believe that. But that is the difference between the United States and, say, China, never mind Taiwan or Japan or other Asian countries where civil liberties have play a very different role. In the United States, there is not a single municipality that has instituted a law that says if you do not wear a mask, you can be arrested. I have not seen a single arrest in the US if you don't wear a mask. And now we're talking about a cultural difference. So yes, the policies that the Trump administration pursued did lead to more deaths than were necessary. But what was the alternative? We could not pursue the policies that Taiwan or China or Japan pursued because that would have been unacceptable to the American people. I'm pretty sure that if you put that to a vote to the entire American people, you will not win. You will not have a majority that will agree to enforce a law to require people to wear masks. And so what I'm left with is what the terrible price of freedom is in this country. We paid a terrible price over the last 9 months. I hope it was worth it. I don't know. I don't know if it was. I can't say. But that's how I interpret it. And I'm hoping that in the next administration, President-elect Biden will choose a different path and that the population of voters who elected him have now realized that we need to pursue a different policy. Let me get to your second question, which is one about the Fed. So I'm actually very worried about the enormous stimulus that we have put in place, much more so than in the 2008 financial crisis. But what worries me is not so much the magnitude, but rather the lack of accountability and the fact that we don't have clear design on when we're going to eliminate those programs. So in 2008, it was very clear that the Dodd-Frank Act and all of the policies that followed from it, they were designed in a bipartisan way where it was clear that we wanted to deal with the financial crisis, but at the same time, we also wanted to make sure that we didn't ultimately stifle the financial system and that we didn't create hyperinflation. I don't know that the current administration has had that same sensibility, but I am comforted by the following fact, which is that the new administration, the Treasury Secretary that President-elect Biden has chosen, Janet Yellen, knows very, very well what the consequences are of an expansionary monetary policy. And I believe that she will take the brakes off before we get to that stage. So I'm hopeful, but as I said in my slides, I'm actually quite nervous because I don't know what will happen, especially if we end up having a Democratic Senate as well as a Democratic House of Representatives. If that's the case, we may end up pursuing more expansionary policies that could lead to hyperinflation. I'm hoping that won't be the case, but remains to be seen.
Any other questions from online and from the floor? Huh? There's some question online. Would you like to address it?
Sure, yeah, I see the question. So the first question is, with the time difference in the US, China, and other countries, I am wondering how you match the high-frequency time series data minute by minute. That's a really easy answer. We use US-based ETFs only. And so those ETFs actually trade during 9:30 to 4 at the exact same time. So this way, we don't have to worry about market differences in timing. Otherwise, we would not be able to do this kind of causality analysis. And so we are doing it during US hours, so you might think there's a bit of a bias, but these are other countries' ETFs that are based in US currencies. So we're expecting that the information content will be comparable. And then the second follow-on question was, do you think the informational efficiency in the financial market has improved over the past decade since the 2008 financial crisis? So that's a really great question because, you know, it highlights how I think about markets in a way that may be different from the traditional framework. So the neoclassical framework would argue that, you know, markets either are perfectly efficient, or if they're not efficient, then they're getting more efficient because the frictions are going down and competition is increasing and so on. And in the limit, everything is perfectly efficient. I don't look at markets that way. To me, markets are more like complex ecosystems that change over time as a function of market environments. So for example, while I do believe that markets have become more technologically advanced, so we can now trade much more quickly than ever before, but at the same time, we also have flash crashes. So I believe that today, we have more possibility of flash crashes than we had back in 2008. Is that more efficient or less? I would argue that that's an example of an inefficiency, but I do believe that prices, most of the time, do fully reflect all available information. So I think that the idea of informational efficiency, number one, it needs to be quantified. We need to have a measure, a metric of efficiency. And if we had a measure of efficiency, I think what we would observe is that it would fluctuate over time. During COVID, the informational efficiency went down dramatically. After we stopped freaking out and we started thinking more rationally, informational efficiency went up. And when there's a next crisis, we're going to see it go down and then up and so on. It's a dynamic that really doesn't have a steady state. I don't believe that markets are in equilibrium for very long. I think that we are constantly moving around from one pseudo-equilibrium to another one with very lengthy periods of transition where markets may not be determined by these kinds of free-form flows. The next logical question is, what do I think is a good measure of informational efficiency? So I have a very simple measure. When you're talking about market exchange traded instruments like stocks, one very simple measure of informational efficiency is the first order autocorrelation of returns, whether it's minute to minute or day to day. If you look at the first order serial correlation, it turns out that that's actually a pretty good measure. Why? Because serial correlation can't be that large, because if it is, that means you can forecast markets. And if you can forecast them, that means that they don't contain all available information. One of the beautiful things about the random walk that Eugene Fama and Paul Samuelson observed is that if markets are working well, if people are competing and incorporating information into market prices, they're not predictable. So the random walk or martingale hypothesis is a direct result of people competing and trying to make it more efficient. And so when you measure the martingale property, one way to do it is by the first order correlation, the other is by a variance ratio, a statistic that my former colleague at Wharton, Craig McKinley, and I came up with. But there are many different measures. If you just use that simple measure, that's a way to rank order informational efficiency. The larger the autocorrelation, the less informationally efficient a market is.
Okay. Any other questions from the floor? Yes.
You mentioned
Oh, I'm sorry, I don't hear anything.
Okay. You mentioned the current working paper on the global realignment. Do you have any possible reasons for that? Because to me, this kind of a global realignment or paradigm shift should occur in the period of 8 decades, not 8 years. So
That's
this
right.
dramatic changes of this it's surprising to me. Thanks.
It is surprising to me too. I agree wholeheartedly. I don't have an explanation yet. We're planning to look into it in more detail, obviously, in terms of the research that we're doing. Our first objective was to document it. If I had to guess, my sense is that the rise of the middle class in China and the dramatic growth in market volume over the course of the last decade has explained the importance of Chinese financial system in terms of affecting other markets. On the real side of the economy, I think the same thing has happened. Population growth and the tremendous productive capacity of the Chinese economy has now led to trade relationships with all parts of the world, to the point where now what happens in China affects most other large countries. So I think it's really the dominance of the Chinese economy and the growth of the financial system that is now starting to be felt. And when we engaged in that trade war, the US with China, if I had to, I'm not an expert on trade by any means, but as a financial economist looking from the outside, I think we lost the war. I think we lost the trade war in the sense that I think it hurt us more than it hurt China, and it hurt us more than it helped us in the long run. So, but that's an uninformed opinion based upon what I see in terms of the financial interactions that we observe with this analysis.
Yes, Dr. Chen.
I have a follow-up on this particular slide as well. What interests me is that the U.S. is now trying to force some of those Chinese companies listed in the U.S. to go back to either Hong Kong or Shanghai. We're talking about a couple hundred of them. At the same time, the Chinese is leading in some of those new applications in technologies, either AIs and AIoT and others. So how would you look at this situation where the Chinese and other countries may be needing more agricultural products from the US, and the US and the rest of the world is actually going to be more interested in investing in some of those tech shares in China? And would this, also a change in the capital flow? Is the US pushing Chinese securities markets or capital markets growing a lot faster by so doing? And how would it impact the dominance of New York market?
So I could not agree with you more. This is exactly the point that I was getting at by saying that we lost the trade war. By implementing the policies that we did over the last 4 years, I believe that the United States has lost a portion, not all, but we have lost a portion of our international stature. And our loss is frankly other countries' gain. And which country had the most to gain from it? I believe it was China. And I think that President Xi's policies have taken advantage of that situation in establishing deeper ties, deeper trade relationships, deeper financial relationships with other countries. I'm sure all of you saw the announcement recently about the Hong Kong Stock Exchange and the ability now to cross-list between Hong Kong and Beijing. That is huge. I don't know how many people in the US noticed it. I noticed it because I'm interested in healthcare investing, and the biotech sector in China is growing rapidly, and the Chinese government is pouring tremendous amounts of money. So that's a good example where I think over the course of the next 5 years, we're going to see much more interest on the part of the rest of the world, ex-US, in investing in China. And there are going to be some very interesting financial and business dynamics that will emerge that we haven't seen before. So I believe that what we identified in this particular slide, I believe that this is a precursor of what we're going to see over the course of the next decade. One could argue that the 1990s and 2000s might be the decade of the United States in terms of dominance. I think that starting in 2020, this could now be the decade of China and Asia more broadly. So that definitely seems to be one interpretation that's consistent with our data.
I had a question since you just mentioned the topology, the centrality graph. I myself have done a little bit of research with these topologies and centrality. I'm very interested in the graph you show because we usually interpret the node with the highest centrality as the information center. It has information content attached to it. So there is an empirical argument that the node with higher centrality would have higher return. Usually it works, it is empirical tested based on individual stocks or individual investor base, okay? The one that had the highest centrality using whatever centrality measure you have does bring a higher return. So I was wondering if the situation is going like this, the US centrality has been decreasing while the Chinese centrality increasing. I was wondering whether there will be a difference in the market return between these two. I mean, changes over time. Is there any association between stock market return and stock market centrality? That's my first question. Yes. I'm sorry. And a related question to the network is modularity. It's another topology parameters. It measures how the individual nodes clustering together. As the world supply chain changes, I wonder if the modularity also changes. It will be interested to see that.
Yeah, so those are two great questions. Let me take the first one first, which has to do with whether or not the returns are necessarily going to be greater. So obviously, we don't look at that. We don't answer that question here. All we're doing is documenting the fact that China has become more central from the perspective of the ETF. However, your conjecture actually seems quite plausible in this case, because if you think about centrality, how does centrality emerge? It emerges because a particular market or economy becomes more important relative to the rest of the world. And if that centrality is significant, then you would expect that you should earn a higher rate of return. In fact, if you look at the United States, starting in 2012 using this measure, from 2012 all the way to 2017, you would expect, based on its centrality, it should have done well. And in fact, if you look at that time period, it has done well. Now, that's just one data point for one country, so I don't want to make a big deal of it. But I think that your point is well taken. And if I had to make a bet based upon these numbers, certainly it would argue that the Chinese economy and the Chinese financial system might be a very good bet over the course of the next decade. So that I would argue makes sense. Your second point about modularity, I think is actually another really interesting one. So it turns out that we don't actually know, how the topology of the financial network is related to the underlying economic or trade network. I think that the relationship is not as tight as we would like, because what we're observing in the stock market is obviously a forward-looking measure of what's happening over the course of the next 10 or 20 years. Whereas the kind of trade networks that you're talking about, supply chain and so on, is something that is a much shorter time scale. But I do think that there are certain relationships between the two that we need to be sensitive to. And perhaps that's the way that we ought to think about it, that eventually the short-term kind of network topologies of trade relationships ultimately have to translate into the financial topology of the various different markets and how they are related to each other. But on a day-to-day basis, those links, I think, don't have to be all that tight, and we can see substantial periods of deviation over various different market conditions.
Thank you. I just noticed that there are two more questions online. There are two more questions online. Did you read it?
I can.
Yes.
So yeah, can you talk more on the measures for market efficiency or measures of inefficiency, particularly characterizing the two extreme market scenarios of rationally efficient versus heuristic irrational market status? For example, I am not able to sense how insane the market is going with a positive or negative first order correlation from the return. How would you comment on that? Okay, so I understand what you're asking. If you want to understand a measure, if you want to come up with a measure that is related to insanity, there's actually an even easier measure, which is construct a very simple trading strategy. So in 1990, Craig McKinley and I published a paper titled "When Our Contrarian Profits Due to Stock Market Overreaction." And in that paper, we developed a very simple trading strategy, a mean reversion strategy, where today you buy yesterday's losers and today you sell yesterday's winners. So it's a market neutral portfolio. The weights sum to zero. And what you're doing is simply buying and selling stocks that have underperformed or outperformed the day before, okay? That simple strategy, if you simulate it, you would observe that for much of the 1990s and early 2000s, the strategy made a reasonable amount of money, but not a crazy amount of money. And then during 2008 and the financial crisis, it actually made a tremendous amount of money. What does that indicator tell you? It's basically a very simple trading strategy that describes to you the fact that prices aren't following the usual relationships. And as a result, it does not have the same kind of rational equilibrium pricing as you might expect. So that's one of the reasons why, when you use a simple measure like the correlation, you can actually capture it. But using the profitability measure, like a simulated return of a portfolio strategy, that will tell you directly whether or not you're in an efficient or an irrational marketplace. And by the way, there are many hedge funds that do this, right? They simulate these returns, and when they look really crazy, then instead of the hedge funds publishing a paper, they launch a trading strategy and they make a lot of money. So I think that's a direct way of capturing this kind of sense of inefficiency.
But Chen has another question. Yes, please.
Yes. With more automated trading and more high-frequency trading in the market, oh, sorry, I thought I was reading, but please go ahead.
Sorry, I just don't want to waste this opportunity, seeking your advice. Basically, I'm looking at the credit spread between the Treasury in the U.S. and China, and you look at the possibility that some of these equities in China were largely undervalued. And there is also a potential, at least a claim, that the U.S. is actually, waging a currency war. So would you comment on the possibility that if we put all these into perspectives, that the China is actually going to gain a lot because they, either equity market or treasury market or even currency market, I think it will be logical for investors to think that, I ought to allocate more in the Chinese market, whereas in the U.S., I don't see the U.S. market being that attractive except for those few very big tech firms.
Yeah, I agree with you. I think that that's exactly right. But however, I don't necessarily believe that there's a systematic currency war that's being waged by U.S. central banks. I could be wrong. I'm not privy to what the Fed is doing, and clearly they do engage in open market and currency operations. I think that the United States is going through a period where their policy is rather confused. I don't think that we have had a consistent policy over the last 4 years. I think you'll see a difference after January the 20th. And so it'll be a little bit easier to interpret. I do think, though, that the United States has one benefit that, as far as I can tell, still seems to be pretty substantial. And I don't see that changing anytime soon, although it definitely could. And that advantage is that the United States actually has the reserve currency of the world. Now, there's no doubt that other people, other countries are becoming more relevant in terms of trade-weighted currencies. But the fact is that even with these trade-weighted currency indexes demonstrating that other countries are having more influence, the dominant factor still is the US dollar. And mainly it's because countries that want a safe asset want to put it in a place where they know they're going to get the money back. And typically that is the country that has the most nuclear weapons. And so this is a very safe country from that perspective. I think that that will last a while longer. And while that happens, I think you may end up seeing some very strange relationships with respect to currencies and credit spreads. But ultimately, I think that that is something that will persist until and unless the US loses its world leadership dominance.
Okay, I'd like to bring the issue back to the risk-return trade-off. Okay, it's very puzzling. I mean, it's very important, the risk-return trade-off relationship, but it's very difficult to figure it out. I mean, what exactly is the relationship between risk and return? We use different risk measure, different time frame, we get different result. And from your page 10 rolling risk return, the table, we can clearly see that if we use the stock price return and measure the volatility using rolling 5 years, we see that the risk return trade-off changes over time. Sometimes it's exactly like what we used to believe, that there is a positive relationship between risk and return. Sometimes it turns into negative relationship. And if we look at your table, I don't remember which page it was, about the firm characteristics and their return. I think it's young and old firm, more tech versus low tech firm. We see that the return after the pandemic for the high tech company has higher return, and the traditional company has lower return. So there we see a positive relationship between risk and return in terms of firm characteristics. You have high tech company have higher return after the pandemic. But what I'm trying to say is exactly how should we look at the relationship between return and risk? Of course, it may be adaptive, as you said, but is there something that underlying all these adaptation that we can sort of make a principle out of it? That's my question.
I think there is. That's a wonderful question. There is something, but it's subtle. In fact, I was talking to an economist about this earlier today, who was saying that he was very frustrated that the traditional measures of valuation don't seem to work anymore. That if you look at PE ratios or dividend yields, the traditional valuation metrics, they all seem to be completely off base. And so how are we to think about all of these different things? So it turns out that I think there is a way to make sense of this. And the way to think about it is that ultimately the risk premium is going to be focused on the particular aspects of the economy that generate value for the population. And that's one of the reasons why the risk premium changes over time. As environments change, as market conditions change, you're going to see these risk premia change. They're going to adapt. So, it's a very convenient thing for us to say there exists the risk premium and it is 6%, because we want to use a simple number to plug into our cost of capital formulas. But the reality is that the risk premium is a function of the environmental conditions. So one example is, going forward, I would expect that healthcare is going to yield a higher expected return per unit risk, simply because now there's going to be more investment focused on healthcare, and you're going to see more discoveries. It's going to mean more to the population. And as we grow as a society, healthcare is going to become a more and more significant component. So that's a simple adaptive explanation for what's going on in the economy and how to change our valuation metrics to take that into account. The other example that you pointed to, I want to come back to, it's a really important one, and that is technology companies. I don't know if you remember when Amazon was first launched, and as it started to grow, people would look at the Amazon numbers, they would look at the business model, and they would say, Amazon, it makes no sense. The company is growing, but they're not profitable. And so, how can we think about this company? How do we value it? The traditional measures don't make any sense. And it's because the traditional measures don't capture the way that online retailers make money versus regular retailers. It's a different method of generating value. And so once you figure out what the metric is, the number of clicks in a particular click stream, or the number of repeat orders for certain items, the magnitude of the data that Amazon has on the customer base, all of those things are new ways of measuring the same old quantities, which is basically future cash flows. So I think that from a financial economist point of view, that has not changed. If you can increase future cash flows, you will have a higher NPV. But the traditional metrics that Wall Street analysts use, like earnings per share or multiples or dividend yields, those don't necessarily capture the impact on cash flows the way that click streams do, or the magnitude of the databases that these companies are amassing. So, with the technology revolution, we now have a new set of methods for generating business opportunities and revenue, and we have to change our metrics to capture that. One example of a metric that I have not seen yet anywhere is the value of the data that companies hold in their inventory. That database is incredibly valuable, but you will not see it on any balance sheet or income statement. It's not measured. So, for example, Netflix, I believe that Netflix, one of the most valuable things that Netflix has is it has data on what the consumers like to watch and what they don't like to watch. Because with that data, Netflix can actually create programs for their consumers and charge extra for that. So that's an example of something that is still very old, being able to forecast future cash flows, but we need to use new metrics to do it.
Yeah, exactly. I think we consumers should charge all these companies for the information that we been robbed off to these, right. And then they can be priced.
In fact, they do, and it is priced. I can tell you what the price is right now. Do you know what the price is for giving your personal information to a retailer? I can tell you, it's 10%. How do I know that? Because that's what they will give me, a 10% discount if I get a card from them that gives them my name, address, age, and occupation.
Okay,
so
great.
That's a huge number. If you think about how much Walmart is making, or Target, or all of these stores, that's what it's worth. That's the minimum amount of what it's worth. It's probably worth a lot more than that.
It's not happening here in Taiwan yet. I mean, I don't get any discount disclosing my information to all these vendors.
Give it time.
Okay. Any other questions? We are getting, our time is almost up. Is there any last questions from the audience or online? There's one more question. Okay, the last question from online. Jeffrey, yeah? There's one more question. Jeffrey.
Okay. So the question is, can you share some of the insights on the alignment of study that you just shared with implied for the wealth management industry? How shall mutual fund or pension fund manager with the rising role of China from a slower trading frequency perspective? Sure. So thank you for that question. That's a very practical one. And given that I have some experience with money management, I don't feel totally unqualified to answer it. But I have to say, I'm not a financial advisor. So please talk to your financial advisor before you start rebalancing your portfolio. So obviously, given a number of the questions that people like Professor Ma and Professor Chen in the audience asked already, it is pretty clear that Asia is a tremendous opportunity for real investments. And if it's a tremendous opportunity for real investments, then it must be by association a tremendous opportunity for financial investment. Now that doesn't always have to be the case, because we know many examples of countries that have become very, very rich and that have grown very rapidly, but investors in those countries through financial investments have not been able to share in that wealth creation because of weak corporate governance or various other kinds of corporate expropriation techniques. I think that that's changing, and Asian markets in particular have become areas that many countries have started to invest in, both on the real side and the financial side. So what I can say is that if you are a seasoned investor in international markets, then without a doubt, Asia is on the rise, and particularly Asia in certain sectors. The two sectors that I'm most excited about are, not surprisingly, technology, since I come from an institute of technology, but also healthcare. Those two sectors, I think, have tremendous promise, and it's pretty clear that around the world, those sectors are growing. So given the population size in Asia, given the technical expertise that exists in that part of the world, I think from a financial perspective, from a slow trading perspective, those are very, very good opportunities. Now, having said that, how you take advantage of that is a different question. How you are able to access the real returns of economic growth using financial instruments can be much more complicated. And so you have to be more careful about thinking of the various different financial vehicles. Mutual funds may be one vehicle, but I think one has to be very careful, because mutual funds don't have the same level of oversight and information access as, say, hedge funds. On the other hand, mutual funds are much lower risk. So I think there's a trade-off that one has to be mindful of. But the bottom line is that if I were asked by a retail investor right now how to allocate assets, I would say whatever your allocation is based upon the MSCI or other kinds of passive investment weights, I would increase the weights to China, probably decrease the weights slightly to the United States, and decrease the weights slightly to Europe, and increase the weights to Africa and to South America. I think that having a more global portfolio, given what we've seen in this global realignment and the importance of other markets, I would think that a more globally balanced portfolio would probably be a wise thing to do.
I see that there is one more question. Could you just quickly respond to it about flash crash? How to solve it?
Well, I wish I could tell you how to solve it. Unfortunately, I can tell you some ideas for how to deal with it, but I'm not sure that they're going to be solutions. The fact of the matter is that because technology has now become a more important part of the financial system, we are going to have to develop more robust methods of regulation. So we're going to have to develop more sophisticated regulatory tools like real-time machine learning algorithms to identify potential market dislocations. We may have to require program trading firms to disclose their strategies in some kind of a cryptographically secure way to regulators and be able to have the regulators step in when they see a huge order imbalance that's likely to trigger market stops and other kinds of disruptions. So the short answer is that I don't think we can prevent flash crashes. I think we can make our software much more robust. And it's because we have routinely done the same with other technologies. You know, it used to be the case that making a phone call was a very risky proposition, and it would be very difficult to guarantee that we can make an international call without getting interrupted. Now, I can probably pick up my cell phone right here and call somebody in that room right now and reach you without too much of a problem. So technology improves. And I think that financial technology will improve as well. Exchanges will now become more robust in terms of their software systems. But the problem with progress is that as they become more robust, you're going to develop new innovations that will allow us to ultimately end up creating more of these kinds of financial crises. So ultimately, the answer is we need to adapt. And I do think we have adapted. The number of flash crashes in 2020 is definitely less than in 2019, and the ones in 2019 less than 2018. So we're making progress, but the progress does not have to be monotonic.
Yes. Well, our time is up. Thank you for such an, wonderful lecture. And would all of us give him a big hand?
Thank you. Thank you. It's a pleasure and a privilege. I appreciate it.
Yeah, excellent job. I'll see you tomorrow then.
Thank you. See you tomorrow.
Bye-bye.
Have a good rest of the day.
Good night.
Yeah.
Okay. Bye-bye.